joining in. Eric Selvaggi here with Wellington-Altus Private Wealth. I'm with the Aegis Wealth Management Group. Today we have a special guest. We have Chris Rowan from NewGen. He's one of the portfolio managers that we use across our clients' book. So I thought today would be a great opportunity for Chris to introduce himself and talk about the strategy and share some of their valuable insights. So thanks for joining us today, Chris.
Great. Thanks, Eric, for having us and for everyone else who's going to join in or watch at some point. Like Eric said, my name is Chris Rowan. I'm a portfolio manager and partner at NewGen Asset Management. We're a Toronto-based asset manager. We run 3 equity long-short products and 1 credit long-short product, all predominantly Canadian-focused, just under $1 billion in AUM across those 4 strategies. All of them, particularly the equity ones, which are the ones I'm involved with. The first one we started in July of 2012, so we've been doing this for a long time. We're predicated on the belief that the Canadian market is inefficient, particularly in the small and mid-cap space, and we were going to try to take advantage of that. And obviously, we've done a decent job and continue to think that those inefficiencies exist today after that the original thesis kind of thing.
Great. So just for people who don't quite understand, could you just give me an idea of what you mean by long short and what those strategies entail?
Yeah. So when we look at investment opportunities, we would look at both buying a stock, which is going long a stock, as well as potentially shorting the stock. So that's nice. One of the reasons that Canada is inefficient is because most of the people investing and the managers investing are only able to focus on that long side, i.e. they take money and they invest it. They don't look or are not able to look at shorting stocks. And obviously, we feel that there's a lot of opportunity to bet not only on companies going up, but occasionally to bet on them going down. That's one way of us using, our exposure levels to create some downside protection, in the event that the market has a period of turmoil. Shorts are one way that you can protect that way. So, we look at opportunities on both sides, both from the long and the short side.
Okay. And in the long and shorting, is that what you mean by inefficiencies? Or when you're saying inefficiencies, is there another component of the Canadian market that stands out?
I think the main proponent of what causes the inefficiencies that I'm speaking of, which is, the opportunity for us to find a company that we think is too cheap, which we can go long again, or the opportunity we think a company is too expensive and potentially could look to short, is caused by the makeup of our market. And the Canadian market is quite unique, certainly if you compare it to the US, but mostly, other global markets as well. On the developed side, we have a unique structure in terms of where the assets are. For example, in Canada, the majority of the assets are held in one of 3 places, I would say: the pension funds, the mutual funds, and if you want to call it the third channel, would be the investment advisor channel. Certainly those 3 channels exist in the US or other developed global markets. The big difference in Canada is you would have a huge amount in these other markets of managers like us, whether you want to call them hedge funds, investment councils, but really, managers that are able to really focus in the short term, go long and short, et cetera. And in Canada, that's just not the case. There's only a handful of managers that you could even name that have $1 billion plus like we do. And I think, when you factor the liquidity of our market, which certainly is nowhere close to the US, and the fact that you have particularly the pension funds and the mutual funds being so large and so long-term focused when they make their investments, theoretically, there should be some opportunities for things to get mispriced, because if one of these pension funds or mutual funds wants to, let's say form a position in a name that's in the mid-cap, small-cap space that doesn't trade a lot, for them to put it on, in some cases, they might be buying 10, 50, $100 million positions. You can get some moves that could create some opportunities. Likewise, if they're, long a position and they choose to sell that can have, mispriced scenario opportunity as well. And on top of that, I think because those managers are so big, and for reference, I used to work at the CPP Investment Board prior to coming to NewGen. I think when I left, there was about $150 billion of AUM. I think they're about 650 now, just to give you, they're obviously the kind of behemoth in Canada.
Mm-hmm.
But, for them to look at a smaller mid-cap name doesn't even make sense because they're just too big. So again, going back to that inefficiency part of the market, the less people that you have looking at names, theoretically anyways, I would argue, the more opportunity for something to be sitting there that's not priced properly. Again, in the US, if you have thousands of people like us that are looking for these inefficiencies, there's much less likelihood of those being there. And in Canada, that's not the case.
Okay. So when you guys are trying to create, like find an idea of an investment opportunity, like how do you come about? Is it based on what's happening by a large institution, or what are the processes that you guys take to source ideas?
Yeah, so that's a great question. So we have an internal team here. We have 7 investment professionals, and obviously we're looking and evaluating opportunities, consistently. Basically, the starting point for us is, and this is very important for us because we do move so quickly. We like to find liquid names. What we define as liquid names are names that trade over $1 million notional on any given day, so 20, 30-day average periods. Obviously, there's some opportunities where a name might have a big block trade that trades and then goes back to not trading, anywhere close to that $1 million notional. We'll exclude those. For reference, if depending on again what's working and what's not in Canada because of how, sensitive some parts of our market are from a makeup, it's around 500 names. So that would be our typical starting point watch list. Obviously, that sounds like a lot of names. Again, we have 3 equity funds. When you add up all the different names in total between those 3 funds, we probably would have about 100 of those in any of those 500 names on either long or short at any given time. And that gives us an advantage. Again, when you think about what we'd have to do in the US and how many names we'd have to try to monitor, that number would probably be more like 5,000. So that's
Okay.
another reason why we've chosen to focus in Canada, because again, these are names in a lot of cases that we've watched and known about extensively for 15 years that we've been doing this together. So we know the management teams, we know which analysts are the best in terms of how they look at different quarters and opportunities. We know which trading desks to call when we're looking for, color on who's buying and selling names. All of that plays into the advantage that we have by focusing in Canada. So that's the kind of watch list.
Yep.
And then further from there, I would say generally there's 2 types of investments that we would make. One would be reactionary in nature. So some type of news or catalyst has occurred. Again, because we know these names so intimately, in a lot of cases, we're able to make decisions very quickly if we think something is mispriced. And also, again, if you're looking at, our competition being the mutual funds, the pension funds, and those investment advisor channels, they're not really set up to be able to move that quickly in the short term. So we think
Yep.
that's a big advantage that we have. So that would be the one type. I would call that reactionary in terms of the trading type. The
Yep.
other type would be anticipatory, where we see a name that we think is either, too cheap or too expensive. That's great. That could persist for a long period of time. So what we'll look for is some type of catalyst that we think is going to unlock that, or in some cases, multiple catalysts. So that could be, an earnings date, an analyst day, some type of defined date where there's some news coming out that we're trying to speculate on kind of what the risk rewards are. It could be something softer in terms of the catalyst that we're expecting, where we don't have an exact date, but we're speculating around. Could be something balance sheet related, dividend hike, dividend cut, share buyback, asset purchase sale, something else related to M&A, equity raise, anything like that, where again, we think there's going to be some dislocation that gets closed by some type of news coming out. So those would be the 2 types that we of trades that we put on. What we do and everything we do is from the bottom up. So we're not macro managers. We don't make calls on different sectors or commodities and choose to go from there. We evaluate those 500 names and those opportunities that we're seeing. We build the portfolio from the bottom up, and then we'll look at different areas to make sure that we don't have too much exposure across different sectors, subsectors, and I guess more broadly, even the market exposure as well.
Okay, interesting. So, Canadian focused, and I guess because a lot of our clients, and especially with the retail investors, are such a big focus on, I would say, U.S. equity markets. But it appears that this year there's a bit of a discount to Canadian equities to the U.S. equities. So, is that something that excites you guys, or what's your perspective on the differential between the two?
Yeah, I think it certainly is something that we haven't seen in the past, where all of a sudden Canada is getting more interest and outperforming. Certainly, that is not something that's happened lately. So it's a bit of a unique position where, if you go back over the past 10 years, let's say, believe it or not, there was periods within that kind of 2014-15 window where over the last, up through probably 2019, where the TSX actually traded at a higher multiple on a PE basis than the US. They kind of flip-flopped across, which typically happens as the market is quite cyclical. Obviously, since kind of COVID, the US has drastically outperformed and has a much, much higher multiple. I think the forward PE on the S&P is about 22 and a half times. The forward 12-month multiple for PE on the TSX is only 14 and a half. So there's a huge disconnect there. And I think part of that is driven by the makeup of the US market, where we don't have the Mag 7 and obviously the multiples that those stocks are commanding in the market right now. So I don't think we're going to go, anytime soon where we're trading at the same multiple like we have in the past 10 years, like I'd say several times. But I do think you're getting to a scenario where it might make sense for that multiple gap to close. And I think that's what we're most excited about, because, if the TSX goes from 14 times to 16 times, that doesn't necessarily mean that the S&P might even change from its 22 and a half times.
Yeah.
There's some names that we own that would have significant moves based on multiple points of their multiples that they trade at, going higher. And I think that's very unique because we haven't seen the Canadian market outperform. For example, this year the TSX is up 17%. The TSX small cap index, I think, is up 25% in the venture, which again, it's obviously highly weighted towards kind of some speculative mining related stuff, is up 44%. Like those are all three of those are much further ahead than any of the US indices. And that's not common of late. But I think, again, Canadian stocks potentially becoming more investable. I think one big catalyst that we saw was obviously the leadership change. I know the party didn't change. Yeah, we haven't seen Carney really follow through on a lot of the stuff that he's saying, but he's certainly talking a lot more pro-business than what we dealt with for the prior 10 years.
Yes.
And I think that caused a huge amount of capital, foreign capital, to leave Canada. We have a chart in one of our decks, which Eric can send anyone who's interested, which we get from a couple of the prime brokers, which basically sums up foreign capital coming in and out of Canada every quarter.
Yeah.
For the last 5-6 years, almost every quarter has been negative in terms of flows.
Nice flowing out.
And I think that's part of the reason why that multiple difference that I spoke on the PE between Canada and the US has really blown out. And I think, potentially two things can happen. A, even money stopping leaving would be beneficial. But I think what potentially could happen, and I think has started to happen, is you've seen some of that foreign capital come back. And if that happens, you're going to see those multiples compress and get closer. And that would be, very beneficial for A, Canada, and B, for us specifically.
Is the reason for foreign capital coming back purely based on improved sentiment of what we're hearing from the new administration? Or does the weaker Canadian dollar play a role in that as well?
I think it's probably a combination of things. I think Canada is more investable today based on the leadership than it would have been certainly over the last number of years. I think the makeup of our market, which is quite different than the US, we don't have nearly as much tech. We have a very financials-driven, materials-driven, energy-driven market. And those three areas are three that have actually done quite well this year. And I think probably explains why the TSX has been able to lead this year as opposed to lagging. So I think that would be attractive to some people as well. And again, that multiple discount, specifically with a lot of the US people that we deal with. And again, we're getting this color and information when we talk to the traders and salespeople on the sell side. What causes money to come in and out is typically if Canadian names get to a point where they're much, much cheaper and it's a similar business with similar exposures from a macro perspective, they'll come and buy it here. When that multiple gets higher, and like I said, there was several points kind of in the last 10 years where the TSX broadly would have traded in line. That would be similar if you look down on sectors and subsectors. They'll obviously sell a Canadian name and go back and look in the US for a similar type valuation. But if the valuations get so cheap or relatively cheap in Canada, that's when you'll see money come back. And I think that's what started to happen alongside of people saying there's been a change at the leadership level. There's a much better or more focused pro-business approach. And then I think the makeup, again, the materials and energy and financials being such a bigger part of our market weight than the US is right now anyways, I think quite attractive.
Okay. So energy, materials, and financials. And I know a lot of the small to mid cap companies have been outperforming compared to the larger companies on the TSX. Are those smaller companies, are they focused more on energy and materials? Is that where you're seeing a lot of the depreciation come from, or is there another sector that's really taking off right now specifically?
I would say the broader market here has been quite good.
Yeah.
It's not specifically related to those sectors. I think for us, the sector that we've had the most success in this year has been the material space.
Okay.
That's a broad sector, so that would have, your precious metals, your base metals like copper.
Yeah.
It would have uranium, it would have steel, it would have lumber. Like there's a huge subset within that material sector.
Yeah.
But particularly in that kind of precious metals and base metals sector and uraniums, there's been some very good opportunities, some really good risk reward opportunities that we've been able to take advantage of. So that's been a big driver of our own focus and performance. But I think generally across the board, the industrial space has been great. There's been some tech names like Celestica has been a huge win in Canada. Shopify obviously continues to do pretty well. So I don't think it's limited to those sectors, but certainly I think, you've seen some outsized move within those kind of material space. The energy space is different. I think obviously oil kind of being range bound and towards the lower end of the range has put a bit of a dampener on some of those stocks. We're potentially coming into kind of September, October, which traditionally from a gas perspective has been a good time to own some of the energy space. But I think obviously, when you look at oil, there's obviously a lot of macro moving parts, so to speak, with OPEC and some of the conflicts in the Middle East, et cetera, which are making it a little bit more hard to make bets on. Because, from our perspective, anyways, in NewGen, ideally we're trying to not make bets based on stuff that we can't control, like, OPEC or Middle Eastern conflict.
Yes.
We're betting more on specific companies, specific management teams and businesses. So the nice thing for us is we don't have to own the sectors just like the TSX composite.
Yeah.
We can have zero exposure to certain sectors and a little bit more. Now, we're never going to have huge exposure to one sector because that's not what we're trying to accomplish here. But if there's a sector like energy where there's not a lot of individual movement and fundamentals that are causing the daily share price changes, it's more is oil up or down, we can just avoid that.
You can avoid that
if we need to. Yeah.
Okay. Okay. So I believe that in 2024 there was a decent amount of M&A within certain industries. Can you just talk about that a bit and maybe the outlook for new activity in 2025 and beyond?
Yeah, I think it's an interesting point to bring out and probably kind of ties together some of the stuff we've been chatting about so far. So in 2024, there was a record amount of Canadian companies that were publicly listed that were acquired that had a market cap over $100 million. So we excluded anything below that threshold. I think it was 44 names or something like that. So that was a record from a number, which I think is relevant. The other interesting thing is, which maybe is even more relevant, typically your average premium on a takeout is around 20-25%. Those 44 names that were taken out, the average premium was over 60%. And I think that's relevant because I think, if you tie in kind of that valuation discount that I spoke of earlier, I think that really goes to back up that there's a lot of stocks that are not properly priced in the market. And I think if these companies that are buying these companies, which are a makeup of both private equity buyers as well as other public companies, and they're willing to buy a company for 60% was the average. We saw, a number of names closer to 100% premiums on takeouts. If a company is, willing to buy a company for 100% premium, they're clearly telling you that the market price is not correct. So I think either, and we've seen that M&A wave continue at basically a similar pace. I think we haven't seen quite as many takeouts in that kind of 60+% range. There's certainly been a few, but also the TSX is up 17% this year. So some of that would have been reflected in the moves likely in some of these names. And I think it really goes back to two things. One, the company's willingness to buy that and pay that tells you that it's not priced properly. But two, I think typically the management teams and boards of those companies that are getting acquired have probably told the buyers who likely started at 20 or 25% premium, you can buy us, but it's not going to be for 20% premium because our share price is worth a lot more than what it's trading at right now. So I think all of that kind of ties back into that, why is there such a big discount in Canada and will that persist? We're starting to see that discount close a little bit. But I think, one of two things will happen. Either you'll see the multiples broadly and certainly on many stock specific names start to come higher, or if they don't, you're going to see a lot more M&A where companies are still coming in to buy these names because they're just not properly priced. And that's the opportunity is what we're excited about is this is a unique time for Canada because a lot of these businesses are very good businesses, but their share prices are not reflecting what's happening there. And we think because of that foreign capital inflow and because of what's happening in kind of this appetite for M&A, either two things are going to happen. The share prices are going to appreciate on their own, or they're going to get bought, or possibly a combination of both.
Sure. So year to date, you guys have done a great job. Good return so far on the year. Any projections or what you're hoping to see on the back end of the year?
I'd be hesitant to put a number or anything around
of
that.
Course. You meant more activity, yeah.
Yeah, I think we're quite pleased with where we were last year and certainly year to date through kind of the end of August. But I think more broadly, we're just excited about what's happening, what we're starting to see in Canada, like I've discussed, potentially some of that foreign capital coming back in, which should be more beneficial. And I think, obviously we had our April kind of hiccup in the market, but there's been a lot of good things that have happened since. We haven't had inflation run away. We're going to get a rate cut in the US this month. There's some generally decent things happening at the macro level. Where you could see more focus on individual companies. And that's the biggest thing that benefits us is when the market is focused on individual companies and what those companies are doing and rewarding the ones that do things well and punishing the ones that don't do things well, but based on the individual fundamentals of those companies, that is a good market for us. What's not ideal is when correlations go to one and there's not a lot of differentiation based on individual companies and it's more kind of macro driven in terms of what's driving the market. So I think we're potentially excited about, some more focus on that micro. We've certainly seen, a bunch of good things under the hood. I'm not suggesting it's going to be clear sailing because there's always something that can pop up.
Absolutely.
But I am excited about kind of where we're at. Certainly Canada starting to poke its head up and get some people's attentions. And if there's a risk appetite, which I think you'd say there probably is right now in the market, that's generally a good environment for us to continue to generate return.
Okay. And so you said, you mentioned interest rates, and that's a question we get a lot as advisors, the forecast on interest rates. So I'd love to hear an idea of what you guys think the Bank of Canada has in store for the next fiscal
they need to
year.
Keep cutting. That data last week was very bad. They probably should consider a 50 basis point cut at the next meeting. I'm not sure whether that'll happen. And the US is unlikely to do 50 and probably goes ahead with its 25, but there'll be more cuts after that. I think there's some pockets of Canada that are doing well. And there's not an alarm bell, but I think obviously, based on that data last week, there's certainly a need and justification for them to continue to cut. So it wouldn't surprise me if they did a 50 bip cut next, but they're a little bit torn just given where our dollar's at, I'm sure, versus the USD and what the Fed is going to do. So it's possible they might not do a 50, but that's our view would be that they probably should do that.
They should do a 50. Yeah. I guess that's the big concern is maintaining some strength in the dollar, right?
Yeah. So there's, again, the policy, the leadership change, et cetera here, it has stopped going lower. And obviously the USD has really come off against most global currencies. They basically did the exact same thing as when Trump got elected the last time. It had this big spike and then it sold off basically the entire time after. So hopefully that continues and allows the BOC to cut more aggressively and get to where they need to without having a big worry in terms of what it's going to happen to the dollar. The Canadian dollar.
Okay. Are there any specific parts of the Canadian economy that are worrisome to your team that you try to stay away of?
The one area that we have from a public perspective that we haven't spent a lot of time on is the real estate part of the market. Obviously, whether that's on the corporate side, or the office, all that type of stuff, or if it's even more some of the REITs that have more exposure to condos and personal stuff, etc. There hasn't been a lot of opportunity there. We did own that InterRent, which ended up getting taken out. But again, for us looking for the different opportunities, it's a prime example where we don't necessarily have to have exposure in that space.
Yeah.
That's a space that we've chosen to kind of stay away from for now, just because we're not, A, experts in it, and B, I don't think we have a huge view of where either office or the condo market could go. And those would be two parts where I'm still not certain there's going to be a huge amount of strength in either of those pockets anytime soon. But I think broadly the consumer's okay.
Yeah.
Our jobs, obviously we're still trying to work through kind of the immigration issues and whatnot from the prior administration. But, at a broad level, I think the Canadian market and economy is just fine. I think we probably could justify a little bit lower rates, which hopefully starts to stimulate some of those pockets potentially and some more activity from an economic perspective.
And that's good to hear, because just naturally where our client base is, we're in the Greater Toronto area. So many of our clients have and on their own, excluding their assets with us, they have a higher allocation to real estate, right? Southern Ontario real estate. And then you see it, there's a home bias on investment accounts. A lot of Canadians have a big bias towards the Canadian banks as well, right? So what you guys can offer is a complement to existing things that I would say most retail investors don't really have their eye on, right? Because they'll have no idea about all these inefficiencies that you guys see in the small to mid cap. They probably won't be familiar with all of the companies that you guys keep an eye on. So it's a really nice complement to diversify our clients' assets within Canada.
Yeah. I mean, those obviously the banks and the insurance companies, et cetera, technically would fall in our watch list. Just obviously they trade a lot more than $1 million a day. Those are names that are pretty rare for us to ever get involved with. Obviously, most of the investors that we have are obviously well exposed in their own ways, and B, the odd time there's something for us to do, but buying and holding with a 1 or 3 or 5 year view, a Canadian bank, while it obviously has been a phenomenal investment, is just not aligned with kind of our strategy and shorter term focus. So it is a nice complement. I think obviously the bank's numbers over the last couple of weeks were great, and I think that probably is again a pretty good vote of confidence for the Canadian consumer, is for them to be able to perform as well as they did. And obviously RBC's hitting all-time highs, et cetera. That's helping drive our market to an extent, but that's just not something that's a big focus for us. But it certainly presents a very nice complement, because like you said, the pockets of the markets that we tend to traffic in would not typically align with most people's investment accounts, because they are focused on more like the TSX 60 type names, and those typically aren't the ones that we're trading.
That's fantastic. Well, Chris, thanks for your time today. That was an excellent summary of what you guys do. We've been supportive of your strategy for quite a few years now, and will continue to be so. So we appreciate the input, and I'm sure a lot of people watching this will find it incredibly valuable. So we'll wrap it up there today, okay?
Great. Thanks very much, Eric.
All right. Awesome.